Have you ever had this happen? You spot the perfect upward trend line, the market pulls back for a retest, and you get excited. You place your entry, set your stop loss, and target. But then, the market hits your stop loss and then moves exactly where you expected it to. Frustrating, right? Well, what you just experienced is called a liquidity grab, and it's part of the smart money strategy to trap traders like us. But don't worry, in this video I'm going to show you exactly how liquidity grabs work and, more importantly, how you can use this strategy to your advantage instead of being a victim. Here's what you are going to learn today. What exactly is liquidity and how it shapes the market in ways you might not realize? How to identify liquidity zones where most traders get trapped so you can avoid falling into those traps. How to spot where the market is targeting your stop losses and how you can position yourself to profit instead. The different types of liquidity, soft sweep versus hard sweep liquidity, and how you can trade each one effectively. So, what is liquidity? Most trading coaches make this concept seem overly complicated, but I promise that by the end of this video, you'll understand exactly what liquidity is and, more importantly, how to use it to your advantage. In the context of smart money concepts, liquidity refers to those areas in the market where smart money like banks and large institutions are likely to place their big orders. Why? Because these areas are full of opposite market orders, such as stop losses and stop orders waiting to be triggered. These orders tend to pile up around key highs and lows, trend lines, and equal highs and lows. Smart money knows this, and they push the price into these zones to trigger these orders, grabbing liquidity before the real market direction unfolds. It's all part of creating a trap, whether it's a bull trap or bear trap designed to fool retail traders. But once you grasp this, you can stop falling for the traps and start trading like the pros. When identifying liquidity zones, the key is to recognize areas where the market is likely to trap traders by triggering their stop losses or enticing them into positions, only to reverse the price direction. These zones tend to form around common technical levels that retail traders frequently use, such as support and resistance levels, trend lines, swing highs and lows, and patterns like double tops and bottoms. Here's a breakdown of each. Support and resistance levels are classic liquidity zones. Many traders place their buy orders at support levels and stop losses just below them. For example, when the market forms a support level, retail traders expect the price to bounce back. They enter long positions and place stop losses just below the support. However, smart money like banks may deliberately push the price below this level to trigger these stop loss orders, before reversing the market upwards in the anticipated direction. This traps traders, forcing them out of their positions, while larger players enter at a more favorable price. Just like support levels, resistance levels are prime areas for liquidity grabs. A resistance level is a price point where the market has historically struggled to move above, attracting sell orders as traders anticipate a reversal. Many traders place their sell orders and stop loss orders above this resistance level, expecting the price to drop once it hits resistance. However, this creates an ideal liquidity zone for smart money. They know that a cluster of stop losses from short sellers is sitting just above the resistance level. To capture these orders, they may push the price slightly above the resistance level, triggering the stop losses and creating a false breakout. Once the liquidity is grabbed, the market typically reverses, dropping back down, leaving retail traders trapped and larger players in control of the market's direction. Trend lines are another popular tool where traders look for price bounces. When the price approaches a trend line, traders expect it to respect the line and reverse. They place their entries near the trend line with stops just beyond it. However, similar to support and resistance, smart money often pushes the price slightly beyond the trend line, triggering stop loss orders and grabbing liquidity. The price then reverses, leaving traders who got stopped out frustrated while institutions gain liquidity for large moves. Equal highs are levels where the price reaches the same peak multiple times without breaking through, creating a horizontal resistance level. Retail traders often interpret these as strong resistance levels and place sell orders just below the highs, while placing stop losses above them, expecting the price to drop after testing the highs. How smart money uses it. Smart money knows that many retail traders place their stop losses just above these equal highs. To grab liquidity, institutions push the price slightly above the equal highs, triggering stop loss orders and gathering liquidity before reversing the market. This creates a false breakout, trapping traders who entered shorts and were stopped out, while institutions benefit from this liquidity grab. Equal lows form when the price reaches the same bottom multiple times, creating a perceived support level. Retail traders often assume the support will hold, placing buy orders at the lows and setting their stop losses just below them. How smart money uses it? Smart money identifies this as an opportunity to grab liquidity by pushing the price slightly below the equal lows. This triggers retail traders' stop losses, creates a liquidity grab, and then the market typically reverses upward. Institutions take advantage of this fake breakdown, forcing traders out before moving the price in the opposite direction. Now that you understand how liquidity grabs work, let's dive deeper into the two main types: soft liquidity grab and deep liquidity grab. Each type behaves differently, and recognizing the difference can help you spot better trading opportunities. Let's start with the soft liquidity grab and see how it compares to the deeper, more aggressive liquidity grab. A soft liquidity grab happens when the market briefly breaks a key support level but quickly closes back above it with just one candle. This move is called soft because institutions don't need much liquidity to push the price back up. The same concept applies to resistance levels, but we'll cover support first. You can spot a soft liquidity grab using three common price action patterns: pin bars, tailed bars, and engulfing bars. Let's break these down with examples. Let's start with the support level. In a soft liquidity grab, the market briefly breaks below support, triggering the stop losses of traders who went long. Then, it quickly moves back above support. As you can see in this example, a pin bar forms with a long wick below the support. This long wick is a signal that banks or institutions executed a soft liquidity grab, taking out stop losses with minimal effort, and the price is now set to move upwards. So what is a deep liquidity grab? A deep liquidity grab occurs when the market breaks through a key level like support or resistance and continues further, forming multiple candles before reversing. This happens because institutions need more liquidity and aim to trigger both the stop losses of retail traders and the orders of breakout traders. The price goes deeper than expected before reversing sharply, leaving many traders trapped. In a deep liquidity grab at support, the market breaks below a key level and continues moving downward for several candles. Retail traders' stop losses are triggered, and breakout traders enter short positions, thinking the market will keep falling. Once institutions have collected enough liquidity, the price reverses and moves back above support. Now let's look at resistance. The market breaks above resistance, triggering the stop losses of short sellers. But instead of continuing higher, the price quickly closes back below the resistance level. A pin bar forms with a long wick above the resistance, signaling a soft liquidity grab. The institutions grabbed liquidity by triggering those stops, and the price is now likely to move down. Next, we have the engulfing bar. When the market briefly breaks below a support level, triggering stop losses, the price suddenly reverses and closes back above support. A bullish engulfing bar forms, engulfing the previous bearish candle. This pattern signals that a soft liquidity grab has occurred. Banks have collected liquidity from stop losses and are preparing to push the price higher. Now for resistance, the market breaks above the resistance level, triggering stop losses from short sellers. After this liquidity grab, the price quickly reverses, forming a bearish engulfing bar as it closes below resistance. This signals that the institutions grabbed liquidity and are about to drive the price downward. In this soft liquidity grab, the market briefly breaks below support and triggers stop losses. The price quickly moves back above support, forming a tailed bar with a long wick below. This signals that the market rejected lower prices after institutions triggered stop losses in a liquidity grab, indicating an upcoming upward move. For resistance, the market breaks above, triggering stop losses of short traders, but quickly reverses back below resistance. A tailed bar forms, showing rejection of higher prices. This long wick signals that institutions performed a soft liquidity grab, gathering liquidity from the stops before pushing the price back down. At resistance, the market breaks above the resistance level, rising for a few more candles. Short sellers are stopped out, and breakout traders enter long positions. However, after gathering enough liquidity, the price reverses sharply and falls back below the resistance, leaving those who went long trapped. So, how to trade a deep liquidity grab? Wait for the false breakout, let the market break the level, and form several candles. Don't enter immediately, wait for confirmation that the false breakout is over. Look for a close beyond the key level. For support, wait until the price closes back above support after the drop. For resistance, wait until the price closes back below resistance after the breakout. For entry and stop loss placement, enter the trade in the opposite direction of the initial breakout once it closes back within the key level. Set your stop loss just beyond the last candle of the breakout to protect your trade. Now that you understand how to spot liquidity grabs, both soft and deep on support and resistance, you can apply the same concept to other zones where institutions create liquidity grabs. Let me show you how this works. As you can see here, this is a trend line. The market retraced back to retest the trend line. But what happened? Institutions performed a soft liquidity grab, forming a nice pin bar. This is a perfect opportunity to enter the trade, as the price is likely to reverse upward after the grab. In this example, the market was in a steady downward move, respecting a clear trend line. When the price retraced back to test the trend line, it broke slightly above, triggering not only the stop losses of traders who were short but also the buy orders of breakout traders. This was a classic soft liquidity grab by institutions. A bearish pin bar formed right after the break, signaling that the market was ready to resume its downward trend, providing a perfect opportunity to enter a short trade before the price moves lower. I hope you found this video helpful. If you did, don't forget to like, subscribe, and hit the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.